I think last time we have discussed about the majority rule and minority. And then today we can move on topic that is status. Right now, what are the companies can be incorporated as the companies? Basically, yes, what are the companies can be incorporated? There are three types of companies can be incorporated. Limited, unlimited, company limited by current. When we consider the limited company, there are two types of limited company. One is private and public. When we consider the public company, right, they can invite the public to purchase the shares of the company. Invite the public to purchase the shares. Therefore, we name these companies as public companies. There are two types of public companies. One is listed and unlisted. Listed or unlisted, they can invite the public to purchase the shares. Listed companies, they can trade their shares, sell and buy, trade their shares on the stock exchange. But unlisted companies, they don't have that really. Unlisted. Big companies, they can invite the public to purchase the shares. That is one key feature of a public company. We have discussed on the types of company. Right. Now, the word very important term here you see that is invite. Invite the public to purchase the shares. Right. Invite. How company can invite the public? That is the issue. Right? How public company can invite the public to purchase the share? And now actually, when we consider this invite or invitation, we can recognize invitation, right? Invitation or invitation to trade, invitation to offer. Is a concept, right? For example, now suppose last year we have discussed under business law as a shop window. The shirt, right? The shopkeeper displayed a shirt in his shop window with price mark. According to the price mark, it is 3,000 rupees. First step, we can identify displaying goods in shop window with price mark. Right? Then thereafter, this is the first stage. Thereafter, the customer who enters the shop, he demands the goods. He demands the shirt. So that is the second step. Customers demand customers list. And thereafter, the shopkeeper receiving the goods and tendering the goods to the customer, receiving money. That is the third step. Receiving money. Money by the shopkeeper. So we can identify 3 steps in this transaction. According to law of contract, in order to form a valid contract, there shall be a valid offer and acceptance. For an acceptance. For a valid contract, there shall be a valid offer and acceptance. Right? Offer and acceptance. Right? Now, what is the offer in this situation? What is the acceptance? Right? We have discussed about these, right? How we can distinguish, right? Offer from, right? Another concept called invitation. Okay? So, invite the public, invitation. Offer and invitation. Right? What is the invitation? What is the offer? What is the acceptance? In this transaction, we have discussed these things. Right? Actually, what is the offer? Offer means definite proposal made by one party to another. Right? What is the offer? And what is the acceptance? First, we can decide these two. What is the offer? Yes. Yes. Offer and acceptance. Features. Key features of a valid contract. What is the offer? What is the acceptance in this? Right. Explain goods in shop with price mark. Right? Whether it is a definite proposal, valid offer. That is the the issue. Right. So here actually displaying goods in shop window with price mark, it will be treated as an actually the customer's demand, customer who demands the goods, customer's demand, it is treated as the offer. And receiving money by the shopkeeper, that is treated as the acceptance. Understand? Offer, invitation, offer, acceptance. So actually, invitation means this is a mere request to start negotiations. Right? Start negotiation. And actually, the main objective is to engage into a valid contract in the beginning. So here, request is by displaying goods in shopkeeper with price mark. Shopkeeper, right, invites the public to purchase the share. Invite. Invitation. Now, company, public company, they can invite. They can invite the public to purchase the shares. How company can invite? Now, shopkeeper can display goods shopkeeper like this. How company can invite the public? Shopkeeper can here, man, you got right. So, how company can invite the public? How company interpret the public to purchase the shares? Yes, by publishing an advertisement in a newspaper, right? So publishing an advertisement in a newspaper. Advertisement. The newspaper, magazine, or whatever, right? They can publish an advertisement. So that advertisement is treated as the invitation. Invitation to, right, or invite the public to purchase the shares. This is the invitation. Right. Now our topic is prospectus. Right. So this advertisement is named as prospectus. The paper advertisement was whatever the document, right, by which company invite the public to purchase the share. So this advertisement is named as prospectus. Company will publish an advertisement in a newspaper, right? By inviting the public to purchase the share. Right. Then thereafter, what is the second step? After publication of the advertisement. Yes. ඊට පස්සේ මොකද general public, here the customer demands the goods. So likewise, what is the second step with regard to shares? Yes, shareholder, prospective shareholders, so general public, future shareholders, they will apply for the share. Right? Demand here, demand. Likewise, here we can say, right, apply for the shares, application. So the formal way, there's an application, right? So by that way, and they can apply for the shares, application. Then after application, what is the third step? Now we are receiving money, right? So that is treated as in this transaction, acceptance. Yeah. After application, company will allot shares to the public. Allotment. Allotment. Right. Allotment. සමාදම කොටස් අයදුම් කරනවා. ආගම කාර්යපත් විභජනය කරනවා. විභජනය. allotment is treated as the acceptance. They are not actually that prospective shareholder, but his name will enter on the members register. Right? He will become the member of the company. That is the contract made between company and the member. He will become the member of the company. Allotment. And so we can identify three steps, right? Prospectus, that is the advertisement. Application made by the prospective shareholders. The third step is allotment. Company can allot shares to the applicant. Allotment. That is right, equal to acceptance. And then valid contract made between company and the shareholder member. Right? He will become the member of the. So by using this method, company can raise its share capital. The company can raise their share capital. They can invite the public to purchase the share. Right? So three steps here can make a chance, prospectus, application. And thereafter, we are going to discuss about the content of the prospectus, this paper advertisement. Right now, actually, according to the Companies Act, in this prospectus, in this paper advertisement, the company shall mention some information. Some information of the company. Some information. And they have to mention some reforms. Reports. They have to mention information right, set out in the part 1 of the fourth schedule. Part 1 of the fourth schedule. Part 1 of the fourth schedule. We have to mention some information mentioning part 1 of fourth schedule. There are several schedules to the company strategy. We have discussed about the first schedule, right? Model set of particles set out in the first schedule to the companies. That is first schedule, the fourth schedule, right? Some information they have to be mentioned. Some information mentioning part 1 of the fourth schedule. And reports actually mentioning part 2. Part 2 of the same schedule. Part 2 of the fourth schedule. Schedule के ऊपर लेकर ऊपर लेकर के कितने आदमी ऊपर लेकर कितना पाले ऊपर लेकर right अलग ऊपर लेकर तो ये ना मॉडल सेट का पार्ट कंपनी का मॉडल सेट का पार्टिकल्स कहते हैं ये आप यार अडॉप्ट करो right कंपनी का अडॉप्ट मॉडल सेट का पार्ट here some information mentioning part 1 of the fourth schedule. Some mentioning part 1 of the fourth. So information, some of information and reports. They are mentioned. When we consider the reports, there is auditor report. These are the reports to be mentioned in the prospectus, auditor's report. Auditor's report. Accountant's report. These are the basic reports to be mentioned in the prospectus. Auditor's report and accountant's report of the account, report of the audit. Right now, we can move on to the information. The information to be mentioned in part 1 of course. Actually, there are several information mentioned in the part 1 of the course schedule. Right? Name and addresses of utilizers, right? What is there? Right? Out of this information, very important information that is minimum subscription. We mentioned in the prospectus. Minimum subscription. Minimum subscription. Payment addresses of the auditors, directors, right? Likewise, there are some information to be mentioned in the prospectus. Out of this information, very important information is minimum subscription. Minimum subscription. What do you mean by minimum subscription? Right? This is the minimum amount to be collected from the public in order to allot shares to the public. Right? So if the company is unable to collect this minimum amount from the public, then company cannot allot any share to the public. Therefore, this is very important. What is the minimum subscription? We have to mention in the prospectus. Now, when we consider the minimum subscription, It is consistent. Like these values, that the total amount of these is named as or considered as minimum substitution. Then we can identify some, I think we have some information. Right. All to you, right? One is working capital. What is the working capital of the company? Right. And preliminary expenses. Preliminary expenses. For example, then purchase price of any property. Right? Purchase price. Okay. Another information that you can to the minimum subscription, that is commission payable to underwriter. This is important. Right? Commission payable to underwriter. Right. How much company has to pay for the underwriter as commission. Then thereafter, another information that is right. For these purposes, if the company has borrowed a loan, then that amount also to be included to the minimum subscription. Right? Any money borrowed in the company. For the above purposes. Right? For the above. The value of these, right? Total value of these is named as minimum. Total value of all of these, right? Is named as minimum subscription. And I think you all aware of the working capital, preliminary expenses, purchase price of any property, right? And now the right. Another very important right information, that is commission payable to underwriter. We discuss about this. Thanks. And any amount borrowed by the company for the above purposes, right? Money borrowed, a loan taken for right above purposes, that amount also to be included to the minimum subsidy. The total of all of these, right, is named as minimum subscription. So without collecting this amount from the public, this company cannot allot any share to the public. Right. Right. Minimum subscription. Right. Total of all of these amounts, right, is named as minimum subscription. Then we can go on to this one. Commission payable to underwriter. Commission payable to underwriter. Who is an underwriter? Underwriter. an underwriter and the company engage into an agreement. An agreement made between underwriter and the company. So we can identify two parties. One party to the contract is the company, and the other party is an underwriter. Underwriter and company. They engage into a contract, an agreement. So it is named as underwriting agreement. Underwriting agreement. Underwriting agreement. Right. Now, actually, as an underwriter, we can consider finance company. Finance company and company engage into a contract. So this contract is named as an underwriting agreement. Finance company. Finance company is treated as underwriting. Right. Now, actually, what is an underwriting agreement? Right. Now, as I mentioned, right, if the company unable to collect the minimum subscription from the public, then company cannot allot any share to the public. Therefore, there is a risk on the part of the company. What is the risk? There is a risk on the part of the company. What is the risk? Whether the company is able to collect the minimum subscription or not from the public. If they are unable to collect it from the public, then the company cannot allot shares to the public. If they are able to collect it, then they can allot shares to the public. So before, right? Shares to the public, right? There is a risk on the part of the company because risk is whether the company is able to collect minimum subscription from the public or not. That is the risk. Now here, in order to overcome this risk, right? In order to overcome this risk, company engage into an agreement with an underwriter. So under this underwriting agreement, the main condition is, right? Main condition is given by the underwriter. What is the condition? Right? Underwriter agreed to purchase, right? Specific number of shares to meet the minimum subscription if the company unable to collect it from the public. So that is the main condition given by the underwriter. If the company unable to collect the minimum subscription, then underwriter will purchase a Galle's amount in order to meet the minimum subscription. The company can allot shares to the company. Understand? Right? So this is the main condition or agreement made between the company and the underwriter. Right? If the company unable to collect the minimum subscription, then underwriter will purchase specific number of shares to meet the minimum subscription. Right? Then company can, right, allot shares to the public. Right? So that is the way how company can, right? That is the way how company can, right, overcome this risk. Right? So this is like, right? Insurance agreement. Insurance agreement. If a destruction was happened to the subject matter of the owner, then the insurance company will agree to indemnify. indemnify the owner. Indemnify the owner. So that the damage, right, will pay by the insurance company. That is named as indemnity. Right? So under an insurance agreement also we can identify this type of situation. But here there is not like that. Right? No any destruction to the owner here. Only thing is, if the company unable to collect the minimum subscription from the public, the company cannot allot shares to the public. Okay? Underwriter will purchase number of shares in order to meet the minimum subscription. And thereafter, company can allot shares to the public. So that is the way how this risk is turned out. Right? Understand. Therefore, now, under the underwriting agreement, whether the underwriter will purchase the shares or not, right? The commission to be paid to the underwriter. Company must pay a commission. Commission to the underwriter. That is the consideration of this agreement. Right? That is the consideration of benefit received by the underwriter. He will receive a commission. That is the consideration. Right? Benefit received by the underwriter. Right? That is like the subject matter is destroying or not, we have to pay the insurance premium. Right? So during that period, we have to pay insurance premium within the subject matter, like the peril, like by a peril, if the subject matter is destroying or not, we have to pay the insurance premium. So likewise, here, company has to pay commission agreed under the agreement, right? Even if the underwriter will purchase the shares or not. Right? Even if the underwriter will purchase or not, company has to pay the commission to the underwriter. So that is the commission to be mentioned in the under the minimum subscription. Right? Commission payable to underwriter is right? So that amount also to be studied from the option. Right? So this is an underwriting agreement. Underwriter, like a finance company, most probably is a finance company, finance company, and the company engage into an agreement. So under this agreement, underwriter will purchase number of shares to meet the minimum subscription if the company unable to collect it from the public. Understand? Right? So whether the company, underwriter, right, finance company or underwriter will purchase the shares or not, company has to pay the commission. So that amount to be mentioned in the minimum subscription. Minimum subscription. Is it clear? Underwriting agreement, right? Very big. And thereafter, these are the information to be mentioned in the prospectus according to the part 1 of the Constitution. And thereafter, Every prospectus shall be dated. Right? This advertisement shall bear the date. Date. There are three requirements. There are three requirements with regard to the prospectus. Every prospectus shall be dated, signed, and registered. Three requirements. We can forget them. So this advertisement prospectus shall bear the date. So this date is treated as the date of publication of the prospectus. Publication. Date of publication of the prospectus. Advertisement. Right? Shall be dated. And signed. Signed by directors of the company and proposed directors mentioned in the prospectus. Now I told you under sum of information, minimum subscription, name and addresses of the directors, auditors, they have to mention. Right. So it to be signed by directors of the company. Directors of the company. Directors, proposed directors, right? Promoters may be signed, right? Or any expertise can sign the prospect. Experts, directors, leaders, right? Proposed directors, promoters, they can sign the prospect. Generally, we can say directors or proposed directors or experts, they can sign the prospect and register. Another requirement to be registered. Right? Registration means one know before the publication of the prospectus, one know before. That is important. One know before. On publication. Of the prospectus, a copy of the prospectus, right, to be sent to the register of companies, ROC. Copy to be sent to the register of companies for the purpose of registration. Right? So without registering, right? Without registering the prospectus, the company cannot publish the prospectus. Right? So this is the requirement. Directly it says publication of prospectus without registering with the register of companies, right? The company shall be guilty of an offence. Guilty of offence. I think fine is 200,000 rupees. Fine is company shall be guilty of an offence on conviction, right? Be liable to pay a fine not exceeding 200,000 rupees. Not exceeding. That is the punishment given. The prospectus is not properly registered with the registrar. Is an offense under the Companies Act. Understood. So there are three conditions to be fulfilled. Every prospectus shall be dated, and they are the date restricted as the date of publication, and signed by the directors or proposed directors, prospectus, and registered. A copy of the prospectus, 1 hour before the publication, copy to be sent to the registrar of company for the purpose of registration. The compulsory requirement. Right? If not, the company shall be guilty of an offense. Conviction be liable to pay fine exceeding 200,000. So these are the right requirements with regard to the prospectus. Very simple, right? They are asked that the next thing, next concept is, right? We have to consider if any untrue statement in the prospectus, untrue. In the prospectus in entry. And what are the reliefs available to the aggrieved party? And untrue statement in the prospectus, right? And the prospective shareholder relies on this untrue statement. He has invested money in the shares of the company. Then what are the remedies or reliefs available to this aggrieved party? Right? Because of this untrue statement. Right? Basically, we can identify there are two types of remedies or reliefs available to the aggrieved party. Right? The shareholder who has invested in the company based on this untrue statement. Right? One is, actually, now, I think you all are aware, we can divide the law into two. Right? Last year we have discussed about it. So the entire subject we can divide into two, civil and criminal. Right? Under civil law, the main objective under civil law is claiming damages. Okay? Damage. Under criminal law, what is the main objective? What is the main objective under criminal law? Here, if it is a civil matter, claiming damages. Right? Under criminal law, right? It means guilty of an offense. Right? Then what may be happen to that person? This convicted person. Yes, punishment. That is the main objective under the criminal matter. And punishment. Imposing a fine or imprisonment. So these are the punishments can be given under criminal matter. Imprisonment. Okay. Now here also mentioned, if the prospectus is not registered with the ROC, right, the company shall be guilty of it. it is an offense, treated as an offense. On conviction, right, be liable to pay a fine not exceeding 200,000 rupees. That is the punishment. Fine. That is right, not exceeding 200,000 rupees. Just that not exceed, not exceed, not exceed, not exceeding 200,000 rupees. Right? So even fine may be 1,000 rupees. That is also not exceeding 200,000. When the first time court can fine only 1,000 rupees. Because the law says not exceeding 200,000. Right? Court cannot impose 250,000 rupees. That is illegal. Not exceeding means 1,000 also not exceeding. Therefore, it is permitted. It is authorized by. So in first instance, 1,000 rupees. Right? Again and again, this company is doing same wrong. Then court can enhance the fine up to 200,000 rupees. Right? There are previous convictions. Then court can enhance the fine. That is the punishment, fine or imprisonment. Right? So these are the punishments that we given under criminal matters. Now again, we can come to untrue statement. Actually, there are some remedies available to the aggrieved party, innocent party, under civil law, if there is an untrue statement in the prospectus. Right? That is, that the shareholder who has invested in the company, right, relies on the untrue statement, he can bring an action against the company directors or experts, right, in order to recover their needs. Right? Investor, right, shareholder, after investing, right, relies on the untrue statement. If he suffers any loss, then he can bring an action for damages. That is under civil law. Any damages. He can bring an action in order to recover damages. That is under civil law. And under criminal law also, there are some reliefs available. Right? That is, if there is an untrue statement in the company's prospectus, then company shall be guilty of an offense. Company that says this company shall be guilty of an offense. On conviction, right? Directors, right? These are officers. We all together we can take officers and experts. Who made the untrue statement, right? Be liable to pay a fine. I think fine is here, not exceeding 500,000 rupees. 500,000 rupees. Again, not exceeding 500,000 rupees. And imprisonment is right minimum. Imprisonment is for a term not exceeding again, not exceeding 2 years. 2 years. Subject correction and this is the punishment. Fine is not exceeding 500,000 rupees. And imprisonment is for a term not exceeding 2 years. For a term exceeding 2 years. For both of these punishments. 4. Right. First one or second one, fine or imprisonment or both of them. That is the punishment. Understood? Under criminal law, right? Right? As the punishment, fine is 500,000 rupees. Right? Fine not exceeding 500,000 rupees. Again, not exceeding 500,000 rupees. Or imprisonment for a term not exceeding 2 years. Right? Filing 2 years, not exceeding again. For both of these punishments. This came that we are going to do. Now understand. We have discussed 290, 230, sorry, 230, section 213 of the Companies Act. We have discussed this is a disqualification to be appointed as a director or promoter. Director or promoter. Under 213, right? Under qualifications of the directors, we have discussed. If a person who is guilty of an offense under the Companies Act, which is punishable by imprisonment, right? Then that person cannot be appointed as a director or promoter of a company, right? For a period of 5 years. For a period of 5 years. Now, this is one example. If there is an untrue statement, and if that person is guilty of an offense, right? And as the punishment, suppose the court has imposed imprisonment, then after the conviction, for a period of 5 years, he cannot be appointed as a director or promoter of that company. For a period of 5 years, he cannot be appointed as a director or promoter. Understood? So, because, right, he is guilty of an offense under the Companies Act, which is punishable by imprisonment. Imprisonment. So, here, right, imprisonment is for a term not exceeding 2 years. If thereafter, he cannot be appointed as a director of a company for a period of 5 years. Only a fine is imposed when there is no such disqualification created. Right? Only fine. But here, imprisonment can be given. Right? Fine and imprisonment, or both of these. Fine or imprisonment, or both of these can be given as a fine. Understood? Right. So here also we can identify. Right. There are two types of punishments can be imposed. Then person is guilty of an offense for the untrue statement containing the prospect. Because of the imprisonment as punishment, court can impose imprisonment. We can identify this is a very serious type of offense. But when we comparing with the this offense, right? It shall be registered. If it is not registered, only fine can be, right? As a punishment, the court can impose only fine. That is 200,000, not exceeding 200,000. But in this case, if there is an untrue statement, fine or imprisonment or both of these can be given. Therefore, it is serious one. When we compare it with the first one, this is serious. That's why imprisonment can be given. That is about the prospectus. Right. Now, prospectus is publication of prospectus. It is only with regard to the public company. They can invite. There is a very important, very suitable word. Invite the public to purchase the shares. How they can invite the public? by publishing an advertisement in a newspaper or a magazine. That advertisement is named as prospectus. In this prospectus, there shall be some information to be mentioned and reports. Under information, the important thing is minimum subscription. Total of all amounts of these is named as minimum subscription. Here, underwriting, commission payable to underwriter. Then we can go to the underwriting agreement. Underwriting agreement, this is an agreement between the company and underwriter. Like finance company. Like example, right? As example, you can consider finance company. Finance company or insurance company, whatever. They agree to purchase the shares. Not to make it. You can finance company. They decide to engage in the contracting companies as underwriters. So under underwriting agreement, underwriter agreed to purchase number of shares to meet the minimum subscription if the company unable to collect it from the company. That's simple thing. Right? So whether the underwriter will call upon to purchase the shares or not, permission to be paid to the underwriter. Eventually, right? Underwriter will purchase the shares or not. Irrespective of that, company must pay the commission payable to underwriter. That is the benefit received by the underwriter under this agreement. Right? Consideration benefit received by the underwriter. Commission. That's the commission. Underwriting agreement, all of them are together. Alright, agreement and parallel they are saying. And they are shall be dated. Shall be dated. Every prospectus shall be dated. Signed. Shall be signed. And shall be registered. The requirement. Right? A copy to be sent to each register of companies for the purpose of registration. If not, company shall be guilty of an offence. Fine is not exceeding 200,000. And the untrue statement is you can identify civil liability and criminal liability. But a civil liability can claim damages. Investor can bring an action. Right? In order to record damages. Right? He can bring an action against the directors, proposed directors, auditors, promoters, right? Who are responsible for the untrue statement. Named the prospectus as directors, he can bring an action. In order to record damages. So under criminal law, the company shall be guilty of an offence. The fine is not exceeding 500,000 imprisonment for the offence in 2 years or more. That is under criminal. But civil liability and criminal liability, there is an untrue statement contained in the prospectus. Right. So that's all. What's your question? Thereafter, we can move on to our next topic. This is very simple. Next topic. Perspectives. That is, right? Capital means funds available in the company. Generally, we can identify there are two types of funds. Shares, share capital, loan capital. Loan capital. So under loan capital, we can identify debentures. Debentures. Right? Share capital and loan capital. Okay. First, we can consider about the loan capital. Sorry, the share capital. Then thereafter, we can consider the debentures, loan capital. Right? Shares. Shares of the company. When you want to you are the expert. Right. What are the types of shares in the company? But what are the shares? Ordinary. Ordinary shares, or we can say equity shares. Equity shares or ordinary shares. Ordinary shares. Another name can be given equity shares. Okay. There are preference shares. Preference shares we can divide into several categories. So these are the preferential types of preferential. Cumulative, non-cumulative. Redeemable, irredeemable. So they are named as perpetual. Other name. Perpetual succession. What is the meaning of perpetual succession? Perpetual. The company has perpetual. The company has a perpetual succession. It means, what is the meaning of that? So I get a course or figure again. Can exist, right? Until and unless while in terms of gestation. Upon the pathway, perpetual succession. Separate person. Right? Exist. Perpetual. Now we have perpetual, irredeemable. Then convertible, non-convertible. So these are preferences. What are the meanings? Cumulative, first one. Cumulative, non-cumulative. Yes. Cumulative preferences. What is the meaning of cumulative? That is, in a particular financial year, if the company are unable to pay dividends to these shareholders, right, then next year, company has to pay the balance dividends to the shareholders. So we can say actually here, these preference shareholders, they are entitled to receive dividends on cumulative basis. Kamuchita varaniya podas. Ekkav ichche gana ganna. Gateway media ekkav ganna ganna. Ekkav wenawa tawa api cumulative. Not cumulative, they don't have that privilege. Right? Due to lack of profit, if the company in a particular financial year, company unable to pay for the preference shareholders, then thereafter, next year, they cannot ask the balance. Right? Non-cumulative. Right? They don't have that privilege. If the cumulative preference shareholders, they are entitled to receive the balance of various amounts, right, of dividends. Therefore, we made them as cumulative preference share. Redeemable. Redeemable means at the maturity date, company can buy back. Buy back. So redeem the shares. Redemption of shares. Right? Buy back. Buy back the shares. Company can buy back at the maturity date. Redeem the shares. विकास कर है. Irredeemable means company cannot buy that. Right? So this type of preference shares will remain in the company until the wind down, right? For a long period. Right? That's why we name them as perpetual. That's long period. Right? Company cannot buy that. At the maturity date, company cannot buy that. That is no maturity date. But you cannot buy that these shares. Convertible. Convertible can be converted to ordinary shares. Right? These are preference shares. At the maturity date, can be converted to ordinary shares. Not convertible means they cannot convert to ordinary shares. That is the Cumulative, non-cumulative. Variable is the answer. Convertible, non-convertible. And thereafter, we can consider the debenture capital, loan capital, debenture capital. What is a debenture? First, we have considered that, right? Give me three features of a share capital. Three features. Movable or immovable? Movable property or immovable? Movable. Movable. Transferable or not? Able to transfer the ownership to another party or not? Transferable according to the provisions contained in the article. Transferable. Holder of the share, right, will receive some rights. What are the rights available to the holder of the shares? It's voting right. Voting right. Yes. Right to have one vote, right, on a poll at a general meeting. General. Right to have one vote per share on a poll at a general meeting. Right? What is the poll? There are two types of voting methods. One is show of hands. Show of hands. And poll. A poll. A show of hands. Again, company प्रकाशक का देखा तो देखा कि क्या करना अपना काम करते हैं. Then on a poll, last time, polling booth here. Maybe you have not been polling booth here, poll. One vote per share. One vote per share. One poll at a general meeting. It is a poll, right? Then one vote per share. Shareholder is entitled to, right? Give one vote per share. What was the take? I mean, you can the show of hands and also show of hands. Those are coming in the products. They can blow some to the head. Like every shareholder has one vote. One vote. Every shareholder has one vote. It is a show of hands. දෙක උස්සන්න බෑ. හරි. ඒක එකයි උස්සන්න. එක කාන්තිය යනවා. So these are the rights given to the shareholder. 1 vote per share, voting on all and general. What else? What are some other rights? Voting rights. Then thereafter, right to receive dividend, right? And equal share in dividend. Equal share. Sharing dividend. Paid by the company. And equal sharing dividend. Right? Okay. Another one is an equal sharing payment. An equal sharing right? An equal sharing surplus assets. An equal sharing surplus assets in the event of liquidation. Event of liquidation. An equal sharing surplus assets. What do you mean by surplus assets? Surplus assets. Common. What's up? Surplus assets. And whatever the right given to the shareholder. An equal sharing dividend paid by the company. Labha given Samana for sucker. That younger person, surplus assets. What is the meaning of surplus assets? Yes. Yes. Surplus assets. So make up for the monetary surplus assets. Right now, in the event of liquidation, right, we can identify 2-3 steps. Basically, we can identify 2-3 steps. First one is, first thing is, in the event of liquidation, we are going to liquidate the company. After liquidation, there is no such company. There is the end of the company. Right. So, first step is company has to collect all the assets. Collect all the assets. Realize the assets. Right. Realize. Realize the assets. Realize the assets. And thereafter, third step is company has to, right, pay off the creditors. Third one means pay for the creditors. That means the creditors. And winding up expenses. Of the proceeds of the money after realizations, by using the money, company has to settle the creditors and winding up the expenses. Right? Then after settling the creditors and winding up expenses, if any amount, right, remains in the company, so that is named as surplus assets. Right? Then after paying creditors and expenses, right? Any amount remains in the company, surplus asset. It is named as surplus asset. Right? After settling the creditors and expenses. Any amount remains in the company. This amount to be distributed among who? Among the shareholders. It will be distributed among the shareholders. Equally distributed among the shareholders. Amount what are senior for the that is the meaning, right? Right to an equal sharing surplus assets in the event of liquidity. That is the right given to the shareholder. That is it. This is the right given to the shareholder. Right. Now these are speakers of the share. Then we can go to debenture capital, loan capital. Right. What do you mean by debenture? It's a document issued by the company. Company signs. On behalf of the company, directors can sign. Right? Director 1, director 2. They can sign. Document, right? Issued by the company, acknowledging to pay, right? Specific rate of interest, like 10%, for a specified period, like 2 years. Specific rate of interest for specific period, and after the maturity, agreed to pay the capital. And after the maturity, capital means the amount invested in the company. That amount, capital, will be paid to the debenture holder. So this document for acknowledgement is named as debenture. This is in writing, acknowledgement. Let's say acknowledgement, right? Issued by the company, right? To pay specific rate of interest for a specific period. And at the maturity, right, to pay the capital to the holder. So it is named as debenture. Right. Another one. We did not discuss about this one. Ordinary equity shares. Right? Actually, who are the ordinary shareholders? Equity shareholders. Yes. Ordinary shareholders. Actually, now when we consider ordinary shareholders, they are the real owners of the company. Right? That's why we name them as equity shareholders. Right? Real owners of the company. Okay, let's mark the line. Real owners of the company. They are the real owners of the company. Right? Otherwise, now they shall enjoy residential profit after paying creditors and preference shareholders. First, priority to be given to the creditor, right? Priority to be given to the creditors and preference shareholders. Second priority given to the preference shareholders. Then, after paying the creditors and preference shareholders, if any amount remains in the company, right, it is given to the ordinary shareholders. They shall enjoy the residential profit after paying the creditors and preference shareholders. Now, here, actually, what is the meaning of preference? Preference shareholders. What is the meaning of preference? They have preference for receiving dividends. Dividends and capital in the event of liquidation. Yeah. Capital. In the event of liquidation, right, company has to give priority to pay the capital of the preference shareholders. And thereafter, we have to calculate the this surplus assets. It to be distributed among the shareholders means that actually it refers to ordinary shareholders. Ordinary shareholders. So equity shareholders. Preference means they have the preference for receiving dividends. Dividends and being paid off the capital in the event of liquidation. Right? Dividends and capital. Right? Capital in the event of liquidation will be paid to the shareholder in the event of liquidation. And now we can consider like this, right? Ordinary shareholders, they are the real owners of the company. Generally, voting rights, right? Preemptive right, voting right, right of distribution, distribution of surplus assets, right? So these rights are given to the ordinary shareholders of the company. You have to consider some rights can be given to the preference shareholders. Basically, all the rights are given to real owners of the company. Preference shareholders, right? They will have preference over the ordinary shareholders for receiving. They have a preference over the ordinary shareholders for receiving dividends and being paid off the capital in the event of liquidation. Therefore, we made them as preference shareholders. Then we can divide the preference shareholders as cumulative, non-cumulative, redeemable, irredeemable, right? Convertible, non-convertible. Right? So that is about the share capital. Then we can move on to debentures. It's a document issued by the company acknowledging to pay specific rate of interest for a specified period and pay the amount invested, the capital amount at the maturity. So this document is named as debentures. Right? Now we can identify some types of debentures. There are two categories we can identify with regard to debentures. One is cumulative and non-cumulative. That's first one. Convertible and not convertible. Convertible, non-convertible. Redeemable and irredeemable. Categories they can identify. There are two types of debentures: convertible and non-convertible. Convertible and non-convertible, it has the same meaning of the shares, preference shares. Right? At the maturity date, right, this amount can be converted into ordinary shares. Two options given to the debenture holder. One is he can recover the capital along with the interest. He can recover. Or the second choice is he can convert that amount to ordinary shares. Right? Therefore, convertible. Right? Convertible debenture. Non-convertible means right, these debenture holders they cannot convert the amount to ordinary shares. Cannot convert to ordinary shares. Same meaning. Right? Now, under preference shares, the convertible, non-convertible means preference share holder can convert it into ordinary shares. Non-convertible means cannot be converted to ordinary shares. Same meaning. Redeemable and irredeemable here, debentures. With regard to debentures, now we are discussing. Right? Redeemable, buyback. Right? At the maturity date, company can buy back. Irredeemable means cannot buy back. Right? Perpetual preference shares. Right? But here, the meaning is different. Right? Redeemable debentures means it means right? Debentures which are issued against right short-term loans. Short-term loan. Right? Irredeemable. These are issued against long-term loans. So generally, the money and interest will pay in the event of liquidation for a long period of time. These are the debentures issued against long-term loans. So that is the meaning. Redeemable, irredeemable. That is about the debentures. So there are two types of debentures: redeemable, irredeemable. Redeemable debentures issued against short-term loan. Irredeemable debentures issued against long-term loans. So generally repayable at the time of liquidation of the company, long-term loan. After a long period of time, like convertible and non-convertible. That's the same meaning under the preference shareholders. Right? Convertible means converted to ordinary shares. Right? But convertible means cannot convert to ordinary shares. Cannot debentures of the company. हम जी email बात कर लेते हैं।
Yeah, let me get normally marker කරන්නේ. මට දැම්මා යාගේ මාක්කර් නෑ.
नहीं ओके मैंने सफारी हरी है ना पे लेकिन शादी का कर इन्हें करता है 5 किलो है
इनको माफ कराते हैं ब्राउज देखिए ना माफ करा बस ना एक मैंने माफ करे
हां ये ना कर ले
माफ कर लेके
Then, okay, and there's another concept we have to discuss under the capital, that is distribution. Distribution of profit. Distribution of profit. So this latter part of the topic is very important. Like all the questions are from this area. Distribution of profits. Right. So generally, the company can utilize the profits on three options. On three options. Company can use profits for three options. Right. One is company can make reserves. Company can make reserves. Right. By using profits, company can make reserves. And the second one is payment of dividends. Dividends paid to the members, shareholders of the company. And two concepts, redemption and repurchase. Redemption and repurchase. Company can redeem the redeemable shares by using money for profit. Company can redeem the redeemable shares and repurchase the ordinary shares. Right. Two concepts: repurchase, buyback. Right. There are three options. Basically, we can identify. Right. Company can utilize the profit for making reserves, right? Payment of dividends, right? And redemption and repurchase. Later on, we'll discuss what is the meaning of redemption and repurchase. Right. Then distribution. Now we are discussing about the distribution. Meaning, distribution means distribution. Yes, consider. Yes. Distribution means transfer of money or property. Money or property other than the shares of the company. Other than shares of the company. The shareholder. Transfer of money or property other than shares. Money, we have to do. Transfer of money or property. Other than shares. Of the company. The shareholder. Transfer of money or property. Other than shares. Now company can issue company shares to shareholders. Right? Suppose in a particular year, the company doesn't have enough profit to pay dividends. Therefore, company can issue shares of the company to the shareholders. Right? So it is not considered as distribution. Right? Transfer of property, money or property, other than shares of the company. So this is named as right issue. Other issuing company can issue its own shares to the shareholders. Right? It is named as right issue. Right? Other than right issue. Transfer of money or property, other than shares of the company to the shareholders. That is named as distribution. Distribution. So actually we can identify there is outflow. Right? Outflow. Money go out, money goes out, outflow. Right? So that is named as distribution. Now here, right, we can identify what are the distributions. Right? Now in here we can identify payments of dividend. Payment of dividends. Right? It's a distribution. And redemption of redeemable shares. It's a distribution of money or property. Company has to pay money into the shares. And repurchase. Repurchase ordinary shares. Company can buy that. So outflow. Money goes out. Distribution. Understood? So that is the meaning of distribution. Then according to the Companies Act, it has defined the dividend. Right? What is the dividend? Dividend, it is defined in the Companies Act, right, as distribution of profits. Right? Dividend. Distribution of profit. Distribution of profit. Other than these two. Other than these two. Right? Other than redemption and repurchase. Redemption and repurchase. That is the meaning of dividend. Right? Dividend means distribution of profits other than redemption and. So here we can identify there are three, right, ingredients or the features included to the distribution. One is payment of dividends. It is considered as distribution. Distribution of profits. Right? Redemption. Repurchase. Distribution of profits. So dividend means distribution of profits to the shareholders other than this redemption and repurchase.
Yeah.
But making research, it is not a distribution. It is not a distribution. Right? This is not a distribution. Payment of or transfer transfer of money or property to shareholder. That is the meaning of distribution. But making reserves, that is not a distribution. Then thereafter, distribution means transfer of money or property other than shares of the company to the shareholder. So basically, we can identify by using profits. Company can make reserves, pay dividends, and redemption and repurchase. Three distributions we can identify: payment of dividends and redemption, repurchase. Right? Therefore, dividend means distribution of profits other than redemption and repurchase. We have discussed. There's another concept called distribution of profits. Distribution. Distribution means outflow. Money goes out. Distribution. Right? So generally we can identify company can utilize the profit on three options. There are three options. Company can make reserves, quantitative reserves. Payment of dividend, redemption, repurchase, redemption and repurchase. So these are the options, right? Company can utilize profits on these options. Okay. Distribution means money goes out. That is, according to the definition, it says transfer of money or property. Money or any other property other than shares of the company. Issuing shares, own shares to the shareholders, it is not treated as distribution. Right? In a particular financial year, if there is a lack of profit, the company, without paying dividends, company can issue its own shares to the shareholders. Right? So that is issuing shares. Right? Issuing shares of the company to the shareholder. So other than, right? Other than issuing of shares of the company to the shareholders, right? Transfer of money or property, that is treated as distribution. Right? Then thereafter, we can give a definition for the dividend. Dividend is a distribution of profits other than these two. So when we consider these options, first one, it is not a distribution, making reserves. Payment of dividends, it's a distribution. Redemption, repurchase. Money goes out, therefore distribution. So dividend means distribution of profits other than these two. Right, other than these two. That is the meaning of dividend. Right, then thereafter another concept. Solvency test. Solvency test. Solvency test. Right. What is the meaning of solvency test? In order to make some decisions, company must be able to meet the solvency test. Otherwise, company cannot make such decision. Right. Now we have discussed this. In private company, right? By way of unanimous agreement, company can engage into any type of transaction, even if the transaction is not compliant with the provisions contained in the articles of association, right? They can engage into any type of transaction by way of a unanimous agreement. But before engaging into that transaction, company must meet the solvency test. Solvency test. Right? Another requirement is before payment of dividends. Right? Before payment of dividends, company must be able to meet the solvency test. Right? If the company is not able to meet the solvency test, then company cannot pay any dividend to the members. Right? What is the solvency test? Yes, how company can meet the solvency test? Right. There are two conditions. On Africa, here, company must meet two conditions. Two conditions. Two conditions. One is, the first one is, we have to check whether the company able to pay its debts in its ordinary course of business. Able to pay debts in its ordinary course of business. Right? In its ordinary course of business. Right? Any technical term to this, the company able to pay its debts in its ordinary course of business. Yes. What is it? What we have to check day to day whether company able to pay its debts. It refers to what? In accountancy, it refers to what? Yes. It refers to what? Yes. According to accountancy, what we call to this, the company able to pay its debts in its ordinary course of business. We have to check whether the company has good working capital. It refers to working capital. Anyway. Working capital. Working capital. Day-to-day business, company able to pay its debts. Good working capital. And the second condition, so second condition, that is value of the total assets greater than stated capital and liability. Stated capital and liability. That is the second condition. Right. This is the balance sheet. Total assets 100. Stated capital 40. Liabilities 30. Right. Value of the total assets 100. That is 100. Greater than stated capital 40 plus liabilities 30. Right. So this is the situation. Yes. Right. When we consider the total assets and liabilities 7. Therefore, we can say 100 is greater than 7. That is okay. Yes. This condition is fulfilled. Right. Then what is the situation in this company? According to the balance sheet. Yes. In the accountancy, what we call to this. Right. Yes, what is the situation in this company? According to balance sheet, now total assets 100, 40 and 7. Then what is that now? As you know, balance sheet be equal both sides. Right? So here, what is the difference? There is 30. 30 plus or minus plus plus. Then what is it? Again, what? Again, what? Loss yes, plus name, plus. Like what is it? Reserves. 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 So we have to check the second condition is whether the company has reserves. Reserves. If these two conditions able to meet, then company can meet the solvency test. Then company can pay dividends. In private company, by unanimous agreement, they can make any decision even though it is not compliant with the conditions contained in the articles of association. Understood? So before making such those decisions, company must able to meet these two conditions. That is the meaning of solvency test. Actually, we have first, right? In simple terms, we have to consider the working capital. Whether the company has good working capital. Right? Instead of working capital, companies that they access whether the company able to pay its debts in its ordinary course of business. And the second condition is, right? In simple terms, we can identify, we have to check whether the company has reserves. Right? Company's access value of the total assets is greater than payment capital and liability. So in such situation, actually we can identify according to balance sheet, and there are reserves in the company. That is the second condition. Is it clear? Okay, at that point we can stop completely, right? Okay. That other part I will do next week, right? That is redemption, reduction, redemption, and repurchase. That is very important. That's our past paper questions also we can discuss.